So this is how the strategy works now. Let's say market is on an uptrend, trending to the upside, like this, right? Let's say the market is on an uptrend. You know, on every trend, either uptrend or downtrend, there's always a retracement, right? There are three moves on the market. There's uptrend, there's downtrend, and then there's a consolidation. So on the consolidation market, you don't have business with this market. When market is consolidating, you don't have business trading. So let's say this market is on an uptrend. Basically, this pullback on this uptrend is where you will catch your entries, right? These pullbacks is where you catch your entries. So, and I discovered that market moves from basically most of the times, not every time. I don't know if it's every time, but market moves from demand zones to supply zones. Yeah, so let me show you how this trading pattern works. This style of trading. Let me show you how this pattern of trading works. So first of all, there's what they call top-down analysis. Before you start engaging on any trade, you have to check from the higher time frames to know where the actual trend is moving towards. You understand? You have to check from the higher time frame. I recommend checking from daily time frame down to 1 hour time frame to know that you can execute on 30 minutes or 15 minutes time frame, depending on the instrument you are trading. If you are trading good, it's good you execute on 15 minutes time frame. If you are trading currency pairs, it's good you start from 30 minutes 1 hour, not less than 30 minutes 1 hour. I recommend 1 hour on currency pairs, but on gold I recommend 15 minutes, 30 minutes, 1 hour. So then let's say this is an uptrend. Clearly, obviously, you can see that this is an uptrend, right? Let's say this market is trending to the upside. So this is where my strategy comes in. This is where my trading pattern comes in. If the market is ranging, like let's say this market is moving just from one, like something like this, ranging, you don't have any business with this market. So whenever market is ranging, the market is not for you to trade with this pattern, right? So let's say this market is trending to the upside initially, right? So on this retracement now, this retracement might be, obviously will be a retracement trend, like a small trend that will retrace to the downside like this. Let me show you an example. So it's going to be a retracement trend that will trace to the downside, like something like this, retracing to the downside. All right, a small retracement trend that's going to retrace to the downside like this, right? And then there is one thing for sure, that this market always reacts from either supply or demand zones. Every move in this market occurs between supply or demand zone. Some of the times it reacts to fair value gap areas, right? So not 100% of the time for supply and demand zones. So let's say this place is a demand area, right? And then even if there's a demand area, there won't just be a single demand area. There might be multiple demand areas, but you don't know the particular one. You're not going to come and guess that when this market gets to this place, like you're not predicting that if this market gets to this place, that it's going to move. You have to avoid unnecessary stop loss and unnecessary panicking if market start playing around your. So this is price action. This is not waiting execution. This is not pending execution. This is market execution strategy, right? So you are waiting for, you are not going to set a buy limit at a demand zone that you see, or another block area that you see, because there are many, there will be many other blocks around this area. You're not going to set anything at any place and say that this is an inducement, and then this will be. No, you're not going to do that. You're not going to be predicting this market. You are going to trade what you see, right? So let's say that this market started trending and there are many zones. So on this little retracement now that the market is doing to the downside, is basically reacting to the other blocks or demand zones, right? Reacting to it. That's why the market is even trending. It's reacting to it, doing all these things, right? And then there's the this market moves with pattern, with formation, right? It moves with formation. It doesn't just move anyhow. It doesn't just move. It moves with formation, all right? So, and let's say this market retraces down to this place and decides that this is a particular zone that it wants to react from, right? And this side is the particular zone that it wants to react from, and keep moving. That decision is not for you to make. The decision is for the market to make. Market will always do what it wants to do at the end of the day. Because why? The reason why is because you are not the one controlling this market. This market does what it wants to do, right? So yeah, this market does what it wants to do, because there are a lot of people reacting to these things. There are institutions, there are big banks, there are big traders. We retail traders, we are not the one deciding that when this market gets to this place, this is price action, right? You trade what you see. So I'm just going to wait for this market to, then I'm going to draw a line from the beginning of my trend, the trend down like this, a formation line like this, all right? So I'm going to draw a line. Let's say this I didn't do this thing. I'll show you live example, right? I'll show you live example. I didn't do this thing well, so this is not how this one is supposed to be sharp. But let's say that this is a demand zone, right? But formally, I did not know that this is where the market will decide to start moving up. I will map out all the demand zones there and just wait. Then when market start trending to the downside, if I don't see any trend, I'm not mapping anything out. You see this? If I don't see any trend, like if I don't see any retracement trend, because this is a retracement trend, small trend to the downside. For this, I'm not drawing this my formation line. All right, so now I now draw this my formation line. Let me label this formation line so you see. I'm gonna label this formation line. So you see, it's called formation line, right? So you see the way it is, right? So, and then as this market is trending to the downside, right? As this market is trending to the downside, then it gets to this demand zone, and then decides to break this line. Anything that breaks above this line, this my formation line, and closes the candlestick that closes full body, I'm entering. Let's say the candle break this line, closes full body here, I'm entering. But if the candle breaks it and I've not closed, I will wait till the candle closes. And then because there are cases, there are scenarios in which the candle might break this line and then later close inside of this line, which means there is a manipulation, or let's say there is a supply zone around here that the market wants to just meet and then keep dumping. The market might just break the line, meet the supply zone, then it traces back into the line and close inside of the line, and then the next candlestick will now keep dumping. So to avoid unnecessary stop losses or losses, you just have to wait for the candle to close full body. Closing full body does not mean that like the candle will not have any wick at all. Like the body should close outside of this line. Outside of this line, it might have wick, but even if he has wick, the wick and body should close outside of the line, not the body closing inside of the line and then the wick will be outside. It should close outside of this line. It should close above, like see the line. It should close above the line, not below, not inside of the line, right? It should close above the line. It might have wicks. That one is not a problem. Then let's say the candlestick breaks the line and closes full body around this area, and I enter. Then my stop loss will be. I'll show you how to put a stop loss. I'm not going to take my stop loss down to this place. My stop loss don't have to be that wide. I'm doing 1 to 4 weeks to go, so I don't use wide stop losses. You get, so there are places you play. So basically, if you want to place a stop loss, you might place a stop loss 2 candles, like the candle that broke the line and the other one before the candle that broke the line. That you count the 2 candles, 1, 2, and put your stop loss. Or you might even put the stop loss below the candle that broke the line according to how long the candle is. If the candle is too long, you just put your stop loss below the candle that broke the line. So anything below that place, I'm no longer interested in this market, right? So you put your entry there, put your stop loss, do a 1 to 4 here, and do another 1 to 4 here, right? That is 1 to 8 already, instead of taking the whole day, 2 days to take that one, right? So this is basically the strategy. So that is the same thing you repeat on this other side too. The same thing, that is exactly the same thing. That is exactly the same thing you will do at this other side too, right? So let me show you again. Exactly the same thing. Market starts trending down like this. You just wait. Then you just wait. Just map out a zone and just wait. Then you just draw your line from the top. Right, market breaks the line. You enter. Put your stop loss where you're supposed to put the stop loss. Then do your 1 to 4 weeks to reward. Right, is practically how the strategy works. So let me show you an example of this strategy that I just showed you now. This market is going to the upside. Obviously, are you seeing it? You are seeing that this market is going to the upside, right? It's pushing to the upside, and then so let me show you. So this market was going up just like you saw now, and then started trending to the downside. I cannot come and draw it like this, all right, because this high and this high is almost at the same point. So I rather just start from here, right, and drag my stuff down. I seen it. Drag my stuff down. So this is a practical example, right? And then just like you're seeing, this is a demand zone. This is a demand area here. There's also a demand area here. So somebody might come and say that this demand area, this zone is going to be the one that this market will react to, and then start going to the upside. All right. As you can see, if I had predicted this market, this is just to avoid unnecessary stop losses and fear and all those things. So if I put my what do you call it, my stop loss here and enter and place this in here and say when this market gets to this place that it will start going up, you see, I will have taken a stop loss and market will still go to my direction, right? So this is it now. So I don't know where this market wants to be, but I know that there's a demand here and there's a demand here also. So, but I'll just map it out. I'll just map the two out and wait. We see this particular one at this bottom side was one that this market decided to respect and start pushing to the upside, right? So after respecting it, it still came up and you see the line. Just watch, bro. Like, I seen this line. I seen the way the market is moving information. Market moves information. It does not just move. It does not just keep moving like that. There's a formation for this market, all right? So as you can see, there's a supply zone here too. You see this place? This place is a supply area. So when the market gets to that place, is on the formation. This supply and the supply zone now, right, is on the formation. Is aligning to the formation, right? And then the market came towards the line. The line is not controlling this market. This my line is not the one controlling the market. It's the formation of the market, right? So you see, There's a supply zone here. Market came there, reacted to it, touched the line. And the reason why it touched the line is because of the formation that the market is following. Not that my line is pushing it or anything like that. It's the formation, the market formation, right? Touched the line and dumped. Then dumped again, came, did what he did here, started consolidating, did not move up or down. Then later broke the line and closed full body candlestick. For me, I went on 15 minutes time frame, right? I would rather enter on 15 minutes time frame because there will be, because of account sizes, right? So this one here, you might be risking a lot that you don't plan for, right? You might be risking a lot that you don't plan for, right? So this, because of your account size, I advise you should use a smaller time frame. I place 1 to Forex to reward.